for us, it's been a great partnership to partner with passive investors and create the opportunity for everybody to win. We all win together. And that's really the beautiful part of what we do.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? Welcome to today's show on Wealth Strategy Secrets. Today, we're joined by Corey Peterson. As the CEO and founder of Kahuna Investments, Corey has acquired over $225 million in real estate nationwide and raised over $95 million in private equity. He's the best-selling author of Copy Your Way to Success, Standing on the Shoulders of Giants, and hosts the Multifamily Legacy podcast. His company's mission is to partner with passive investors to create award-winning apartment communities families are proud to call home. Corey, welcome to the show.
Yeah, thanks a lot, Dave. Thanks for having me.
Yeah, no, looking forward to the discussion. I think the audience is definitely going to enjoy this. You have such an interesting background and journey, to get, where you are today. So why don't we start there and share your background with the audience? Yeah,
I'd love to, man. So I started off, I was a used car salesman, and the kind you'd picture in your mind, that was probably me. Until my wife said I couldn't do it anymore. She's like, she couldn't marry a used car salesman. But really,
what age was this?
I was probably about 25.
Okay.
25, 27, right?
Yeah.
And something magical. It was like 23 years ago. I've been married for 21. So 2 years before I got married, that's when my life changed forever. My mom was married to a man named Bruce, and I call him Bruce Wayne. He wasn't Batman, but he did have a lot of money. And so we go to Hawaii to stay with him. And he's got a home right on the beach. And I'd never seen a guy that had time and money. Bruce had both. And so I had to ask, what do you do? And that's when he said the magic words. He said that he was in real estate and that he owned apartments. Well, I left that island thinking he was the big kahuna. Like he had something that I'd always wanted. And so I had to go kind of figure out what I wanted to do. And I started reading a bunch of books on real estate. Finally, I read that little purple book called Rich Dad, Poor Dad, and the light went on for me. And so from that moment on, I got obsessed with, real estate. And I went full-fledged into it. I started off as a single-family fix and flip guy. And that lasted for about 3 deals, right? I did my first 3 deals, and I ran out of money. I was like, oh, my gosh. And at that point, I didn't really know how to get past it. So luckily, my wife's friend, she had a guy he was a financial advisor. And so when I ran out of money, I was like, I got to go back and get a job because I'd quit my job. I thought it was so great on those first 3 flips. And then I realized I had no income and I couldn't survive any farther than that. And so I got a job as a financial advisor, ended up with Edward Jones. And that was around 2004. And what happened was it was a crazy time because, I put my dream on hold of real estate, but the financial world taught me everything about money, stocks, bonds, mutual funds, insurance, the whole gamut. And I was like, that's what I'm going to do. I was all in. All of a sudden, I changed, kind of moved my cheese a little bit. I still wanted to do real estate, but I thought if I could make enough money being a financial advisor, I could go buy more real estate. And that was great. 2005, 6, 7, all of a sudden, 2008, 2009 happened, the Great Recession. And at that point in time, I had built a pretty solid book of clients and business, and I realized that I had no control, Dave, right? I'm telling you, I had a client that was, him and his wife worked at Intel. They had retired at 65, had about $4 million in retirement funds, right, from 401k between the both of them. I mean, they'd done a great job saving, and we, this was like in 2006, so we diversified this portfolio. And in 2008, they come to me and it's worth half. And I mean, they don't just come in, they come in, I mean, she's sobbing, the guy looks distressed. He doesn't even know what to do. And they're looking at me for advice. And here I was, I told them I was going to watch over their money. But I realized as a financial advisor, Dave, I had no control. I had to say it's the market. And here I was, I was a younger, I thought I was, king hot dingling. Yet I really there's nothing I could do except say it's the market. And then they're like, well, we want to move our money. And then I had to charge them a fee, like adding injury to insult. And so when that happened, my heart just left that business. I realized there is no control on the roller coaster of being a financial advisor. And it is truly indeed a roller coaster. It goes up and down for no reason. And it's emotionally stressing, I think, on my investor pool. Probably a lot of people that are listening to, they can understand that ride. It's scary. And so I actually got fired from that job. When your heart leaves the business, so does your sales. And so that was the best thing that ever happened, because it forced me to go full time in real estate. And all I did was take what I learned in raising capital for stocks, bonds, and mutual funds, and I applied it and I started doing single family fix and flips, ultimately to start buying apartments. I realized that I could not scale single family homes, but I could scale multifamily investments. And so the goal was then to partner capital and put it in the right kind of cash flowing deals that made sense, that could give our investors kind of better returns that they were getting in the stock market. And we've done that very successfully. But here we've come into another storm. And that's the one thing about real estate. It's always going up and down and kind of crazy, Dave. But what I've realized in real estate is we have levers. There's lots of things you can do to manipulate your property to make it more profitable. And I think for your audience, if you're looking at syndicators like me, these are the things you're looking for. Some of the clues you're looking for is how have they performed in downtimes? Because anybody can look great in a good period of time, Dave. It's when the storm comes, what are you going to see? And when that tide comes out, some people are naked. And so you want to make sure that you're understanding what that operator can do. And really, it's the things you'll have to navigate. So we've just come through COVID. Now, COVID was a blessing for most of us in the multifamily sector. But for Corey, I have a lot of student housing, right? I rent to colleges, or to the kids that go to colleges, by the bed. So COVID for me was horrible. It was a very hard time. We had properties that were 100% 3 years in a row, and all of a sudden went to 45%, Dave. And 45% occupancy is a death wish. It really is. And so we immediately, that school year, for when it was COVID, because no one showed up to go to school, they're all doing it remotely or at home. They're not staying at my property now. And so we had to immediately get slim, right? We got a skeleton staff. So we started pulling levers. And I'm very thankful to say that we didn't lose any of those assets, and it could have been really bad. But we consolidated. And this year, something extra that we've done is we've vertically integrated. In other words, we've taken over property management. And so property management, it's a little bit different. Like, why does that matter? Why should you be paying attention? Is it good or it's bad? Just understand that most syndicators in this space, like me, they're usually using third-party management companies. And I've done it for the 15 years that I've been doing real estate. That's what I've done. It's only to this point now that I said I would never self-manage or, create this thing. But I realized that what became more important as I've gone on this journey and I've kind of grown my portfolio, and what I realized is control is more important now than ever. Understanding, and really it's not about, it's about your people. People make or break your business, Dave, right? It's your staff at the property level. It's your ground troops that are on the pavement. Those are the ones that will make or break your company. And when you are using a third-party management company, you do not have access or really control on the people aspect. And so we just knew that we had to get that part of it under control and then influence them with our culture. with our code of ethics, the way we want to do business. And then all of a sudden, and the magic thing about that, and as we move through it, Dave, is that we started seeing all our costs, almost across the line, start to go down. Our general G&A, admin costs started going down. Our payroll started to go down, right? Because we weren't really wanting overtime. And so we said, hey, one of our policies is we don't want overtime. And all of a sudden things started getting done in the allotted time. Well, because we mandated, we kind of created stuff like that. And so those little simple things produce NOI, right? You save money, you're going to increase your NOI. And in a time like right now where we've had interest rates double, 100% increase, even though some of us, we have cap rates, that's an expense that none of us really perform it. And so again, you got to have, this is about being lean and mean on your current assets. I think for a lot of people that are invested in guys like me in the last 3 to 4 or 5 years, it was great. And this last 2 years, it's been very different. It's been very difficult because you have to get lean. You have to get very price conscious integration. I call it Six Sigma. Your supply chain, you want that thing dialed in so you're not got a bunch of stuff sitting on the shelves. You got to be efficient. And efficiency is what's going to win the race right now.
Yeah, such a powerful lesson, Corey. And I think not enough people really talk about it, right? It's just having control. And I think this alternative strategy is very new to a lot of people, to be investing in real estate, to be investing in private equity, because most of us were frankly taught, by the financial services industry that, we're going to outsource our wealth, right, to someone who's smarter than you. And, they're going to manage it for you. But what you get with that is, you basically get average returns for the retail investor. So if you're looking to outperform that, part of the equation is really taking back control. So you have decisions in terms of how you're placing capital, right? How are you allocating today? How are you managing your risk? And to your point, when you're starting to purchase tangible assets, there's so many knobs that you can push, right? It's a living business. And the operator, the other thing that's, I think, very different than the stock market, right, is you have mutual alignment with your investors. So as an operator, you're not going to make money. The investors aren't going to make money if you don't make money. We all make money together,
yeah.
Right? So you're incentivized to turn those knobs, look for new, revenue ideas and new creativity, cutting costs, doing all those things. So I think that point of control just really can't be understated.
Yeah, it really is. And I always say this too, like when I think back to the investor base, it's like, who's going to care more about your money? Is it you or is it somebody else? And I always say it's you. And if you really, once you understand that, you're like, okay, so then taking a little bit more control, a little bit more active, you can still be a passive investor, but control what you're putting your money to. Don't just give it. You think about it, you get to a financial advisor, and what that financial advisor does is he has, Growth Fund of America, and he shows you this, 20-year track record history. And so you invest in it. And I always say, you invest in that fund, and then how many people does it go to till finally there's the one guy that says, we're buying blank shares of this company? And who is that person? And can you call them? You can't. And so you've settled for average returns when the rich and wealthy people understand this, I think, more than ever, is that they understand that if they control their money, they can make it work a lot faster and a lot better most of the time, right? So there's still understanding your risk your risk profile, I think, is more important than ever. But I find that most investors, when they start taking a little bit more control of what they're doing and understanding the kind of investments they're putting, the alternative investments out there, that they can do a lot better than what the average stock market return of 6 to 8% is.
Yeah, for sure. And the other thing that, as I went through that journey myself, I just got so tired. I'd be at the gym in the morning, and all you see is a sea of red, because something happened in China, something happened politically, and you just kind of throw your hands up. You're like, I want to do something. I want to get involved, right? How can I do something? And it's, that feeling of helplessness, right? Just really sucks. But when you can get into, investing in tangible assets and real estate, I see it really as mitigating your risk, really three-dimensionally. Right? Because if you have $1,000, let's say you have $1,000 worth of Amazon, the only thing that you're actually hoping for is that stock value can go up in price, right? But when you have real estate, you've got tax efficiency, you've got passive income, and just like you pointed out, you're driving value every day into that asset to increase your net operating income.
Yeah, I always say everybody expects rents to go up, and we never disappoint them, right? You're always going to make a rental increase every year, even if it's $10 or $15. That's typically the train. And real estate is we're all conditioned from a very young age that we pay our rents, right? If you want a place to stay, you got to pay rent. And if you look at the economics too, this is what I love about the numbers, because the numbers are the numbers and they don't really lie. If you look at the supply and demand for what we do in this real estate space, and particularly multifamily space, there is such a demand for housing for what we do, because home affordability is through the roof. It's hard for new homeowners to actually buy a new house. Like, it's almost priced out of their range. And so what are they going to do? What are their options? They're going to look for places to stay, right? Apartments. And that trend is happening more and more than ever. And then there's a good amount of the population that don't even want a home ownership anymore. They want flexibility. So as you start seeing not every market's the same. And this is where you got to understand the business of real estate. And this is why when I say, from your tribe's perspective, is you're going to look for either syndicators, or you got to learn it yourself. So you either do the work and learn how to invest yourself, or you learn enough about the business and then you find operators like me that you can partner with and then come into their deals with, that have spent, the last 20 years. That's all I've been doing is real estate. So I kind of have my PhD in it, and we help get everybody there a little bit faster, right? But you always have the option to do it on your own. But what I've found is, what most people want is they want some stability. They want the income, the tax depreciation. That's not as great as it was a couple of years ago because of cost segregation and the way it's played out, but it's still pretty decent. And so more and more, it's not about what you make, it's about what you keep. And so
for sure. Just
trying to be understanding the long game of real estate. For us, it's been a great partnership to partner with passive investors and create the opportunity for everybody to win. And that's the thing is, and I think you said it, Dave, best, is we all win together. And that's really the beautiful part of what we do.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com. Yeah, that mutual alignment, I think, is so key because, as you pointed out, again, if you compare that to, Wall Street, they're still collecting fees even if you're losing, right? Yeah. So, it's really their agenda that they're winning, right? So anytime you can really bypass Wall Street and invest in Main Street is a good thing, right? Yeah,
you think about how much money they spend. Why is there a financial advisor, in every corner in every street? It seems like and they lobby this. Like they've conditioned a lot of people's minds to say no. Like if I already when I have people that I know they're in the stock market. And that's all they've done. And they're going to go pitch the idea to their financial advisor. I always say, here's what he's going to say. He's going to say this is a bad idea. And I was like, that's exactly what I was trained to say when I was a financial advisor. Why would you do that? That sounds really risky. Are they going to report, this and this, and you're going to do it with your IRA? Boy, what happens if they don't do the reporting? You're going to lose your qualified tax shelter there. And we would just scare the hell out of them, because really every financial advisor's, their job is to keep assets under management, right? That's how big is your book? You keep money at your place. You don't ever want it to leave. So you scare the crap out of it. You say, well, we would offer, well, why don't you just get this REIT, a real estate investors trust? It's like real estate, even though it's not, right? It's paper asset. But that's the conditioning. And honestly, this is I'm going to give you guys an insider look of what they taught us. Those are the words. And so is that not a slick, oiled salesman? Are they really working on your best behalf? Because if I'm telling you, when I got together with a bunch of my guys, when I was at F&A, we were not talking about our clients' good. We're talking about how much money we're putting in our pockets. And so it's a direct conflict of what we're telling and what they're saying. They're saying one thing to the customer, but it's all about assets under management, 12B1 fees, how big's your book, and what kind of money are you making off your client base? And are you churning that enough, right? I mean, and that's, even though they're not supposed to, but they're like, hey, you should be, offering it and moving money every a certain percentage of everybody's money so you can just create new fees. Scary, but that's the truth.
Yeah, it really is. And I think that's why, we have a significant problem in this country, in terms of retirement, financial education, and really the lack of, assets that people are holding right now. That's, is definitely a little bit scary. And I think, the more you can take back control, as you pointed out, start to invest in some tangible assets, things like real estate, right, that really can make a difference. You're going to start to see some massive gains. Right?
Well, that's why podcasts like yours, Dave, are more important than ever is to alert people and let them know that there is alternatives, and that to talk about the things that we're talking about now is more important now than ever, because people need to be saved. They need to be. Retirement for most people is not good. And so how do we make it better? You got to take control. And what you're teaching, Dave, is exactly what people need to listen to.
Yeah, 100%. So tell us a little bit about the markets that you're in.
So we primarily invest in the Midwest and the South. We find that in the Midwest and South, they're more stable, they're more affordable, and we only try to buy for cash flow, Dave. This is I learned my lesson. So in 2000, I bought properties in 2005, 6, and 7, single family homes. I've sold most of them, but I owned them way through the downturn of 2008 and 2009, and they survived. And why did they survive? Because they cash flowed. And so I've learned that, and I'll never forget that lesson, because I know a lot of people lost their shorts because they bought things that couldn't cash flow. If you can cash flow now, you normally cash flow tomorrow. The markets go up and down and they're crazy, but cash flow is king. So we find that in the Midwest, they don't go up too high, they don't go down too low. That's stable. We like those types of deals. And these are like Oklahoma, Iowa, Indiana. And then we also have a pretty healthy portion of our portfolio is in student housing. And so where we rent, we butt up to colleges, and typically that's almost recession proof, Dave, except it's not COVID proof. Okay. So we learned, because usually with student housing, no matter what the market's doing, it doesn't matter, because when your kid's 18 or 19 and they're ready to go to college, that's where they're going. And so then it's about what we look for is D2, D1. We want to be closer to D1 schools if we can. We prefer D1s, but we'll do D2 if it makes sense, if our location is very close to the college. So proximity to college is very important in that aspect of what we're doing, and make sure we have the right amenities and right structures. But again, though, even in those markets, we typically try to buy assets that are 90% occupied, that are already kind of doing what they need, and then we like to make the micro improvements. Right? Let's go and do remodel, refresh, kitchen refresh, right? We'll replace the flooring and, redo the kitchen, make it look, paint the cabinets, new knobs, stuff that's really very easy for what I call, turn kind of items. It's kind of like you can do it in your sleep. We like those. We don't like to move walls. We're not trying to redo wiring or plumbing. It's just cosmetic stuff. And those are micro repositionings that we can do really well. And we force appreciation in that case.
Yeah. Any other types of differentiation besides your vertical integration, what you've learned over the years that really sets you apart?
Yeah, we've learned that here, funny, we've learned, you have these lessons and it's like, wow, okay. We only try to buy in markets where there's a regional airport, right? I don't know why that's a big deal, but we've done it where there's not, and those have not worked out well. We really look for the trend for growth. We want to see more people moving in than moving out, and we want to see our median house pricing. We want to see that we don't need to see it taking off. We just want to see a steady growth, right? If our home values are just over time, just nice and steady, that helps us a lot. We like that data point. We also like more people moving in than moving out. That's another data point that's really important for us. And then we're also looking at employment centers, Dave. Who are the main employers? And are they growing or contracting? And so sometimes we've been on a property, where we're in Warner Robins, Georgia. For that the location, there's a base. Well, so there's one big base, and that's a big employer. And so we've got to really we're watching that base to make sure that it's not going to be part of any closures, right? And it's a big enough Air Force base where it's actually a transport base where they have the big planes like C-130s. And that's always going to be needed for what we do. So we felt really good with that location, but we did a lot of research in those areas. And so at the end of the day, understanding your markets, you have to really go into it with your eyes wide open, and you're looking for those metrics, those data points. Crime. There's a crime statistic that we look for, and we want to make sure that our zip code is better than the. It has to be a certain metric that green lights it for us, and because crime can ruin, and crime is so weird. You really have to look at it from a zip code perspective, because you can go across the street and there's no crime over there, but on this side of the street, it's bad. So trying to understand that is super important when you're buying these assets. We've had it where we've went on site to properties, and our primary goal when we think we have a deal, Dave, is to go kill it. Like we go do a site visit. Our job is to say, let's kill this thing. And if it doesn't get killed, then it's something we still want to do. But that has to be, I think, for most syndicators. I'm not going to speak for everybody. Like that's our drive. Like we go there to kill deals, and only the great ones select, because our goal, our job is to find needles in the haystack. It always has been. It's always to find the needles in the haystack. And so to do that, there's no special recipe in my mind, Dave. You just got to do the work. You got to, in the markets that we track, we try to underwrite 98% of the deals that come up. Now, we're not perfect, but that's our goals. We want to really do a good initial underwriting to say, does this work or not? And most of them don't. Well, honestly, most of them don't. And then from there, the ones that do, then it merits a site visit. We always do site visits before we make any offers. I know there's a lot of investors that just do sight unseen. We just don't do that. I've never done business that way. I've got to physically put my team on site. We want to, because most of the times you'll go there and you're like, oh, that's a deal killer. We found one. We had a great property, great location. But we get there, there's this little 7-Eleven right next to it. And you wouldn't think, oh, it's just a 7-Eleven. But at nighttime, that 7-Eleven is like lots of foot traffic. And usually foot traffic is not good at night. You want people in home, locked up tight. And so I think we actually saw a drug transaction, right? So we're like, nope, this property is not going to work. There's nothing that we can do to fix that problem.
Yeah, great point. I mean, there's certain things you just don't know until you're actually physically on the ground, right? Kind of surveying things. So great due diligence step. And what do you think? I mean, given today's market dynamics, right, with, higher unprecedented interest rates, right, kind of this reset going on between buyer and seller expectations. How has any of that, changed your business model, and what are you looking for today?
We are stepping on the gas right now, Dave. So we've not bought anything for the last 14 months, right? So we went on a hiatus. We needed kind of everything to play itself out, and we are now starting to see things drop because people that are in these adjustable, rate mortgages, they're coming due, and they either have to sell, or if they're selling, that no one's selling right now because they want to, is usually because they have to, and so that's opportunity. So when do you buy? You buy when there's opportunity, and we may not be exactly at the bottom yet, but we're close enough that we are. And here's the play. I believe the play right now is if you can buy something now and cash flow at today's interest rate, right? And you still have some micro repositionings that you can do, then you can buy. And then, we have a 5 to 7 year time horizon on anything we buy. So we believe that in our future interest rate down the road is going to be better. We don't know what it's going to be, but we believe it'll be better than it is today. And that'll be just a micro little piece that's going to happen, that from 6% to 4.5%, or even to 5, 6.5 to 5 is a huge step in valuation and profitability. So our goal is to buy as much as we can in today's dollars, in today's pricing, with today's rates, and just make sure that our deals qualify in cash flow. If they can do that, then it's a green light for us. We're still going to add our micro repositionings. We're going to add some value along the way, but we're going to get a nice little reset somewhere down the road. We're going to be able to refi our properties, and it's going to smell like nirvana.
Yeah, it makes sense. So Corey, what do you say the future looks like for you and Kahuna Investments? Talking, 10, 15, 20 years out.
Yeah. Our goal is to become a family office. We have a very robust team. As we started, we've been buying deals. We have 10 active projects right now, pretty good size projects. And so as they start to mature, our goal is to keep partnering with investors, but our long-term goal is to become a family office where we're starting to use all our own monies to buy all our own properties, and just keep that machine running. I don't think I'll ever stop doing real estate, Dave. I love it. My son is turning 19. He wants to be in the business. My goal is to find a way to, he can't come work for me till he's about 24. But the goal is, once he's kind of matured and learns from somebody else, he'd come and go into all my departments and get everybody's respect, and then stand with me by my side for a minute. And then my goal is to eventually give him the keys and let him do better than I ever thought I could.
Excellent. Creating a nice legacy there. Love it.
Yeah.
Corey, if you could give just one piece of advice to the listeners about how they could accelerate their wealth trajectory, what would it be?
Take control. Don't stop learning about things that you're interested in. Find things that you're interested in the alternative investment arena, right? Whether it's real estate, maybe it's singles family, maybe it's lending, maybe there's so many different aspects that you can get into, but find something you're passionate about, and then just get involved with it. I'm telling you, you can make so much more money understanding just a little bit. You don't have to understand a lot, but just understanding the fundamentals of what wealthy people do. They make their money work so much better than the average investor just going in the stock market. So by listening to podcasts like yours, Dave, to getting knowledge, and then take action. Most people are, they listen to these podcasts and they don't do anything. And man, it's a shame, because I know if you would take action, it would change your life. For most people, it's a life-changing thing when they take action, especially on the things that we talk about, Dave.
Yeah. Well said. Really appreciate you coming on the show today, Corey, giving so many valuable insights to the listeners. If people want to connect or learn more about what you're doing at Big Kahuna, what's the best place?
Yeah, actually, I would love just to I'll give away my book for free. Copy Your Way to Success. If you'll text the word book, BOOK, to 480-500-1127, we'll send you the book for free. Other than that, go to kahunainvestments.com. You can look us up, see about us, and see what we're doing.
Awesome. Thanks so much for coming on the show, Corey.
All right. Thanks, Dave.